Good day.
What's up, everyone? Welcome back to the channel. Today we're breaking down the Fed's June rate decision because on the surface nothing really happened, but underneath this might be the most important Fed meeting of the year. So let's get straight into it. I made this for the video, this little thing right here. So let's get started right here. The setup. The Federal Reserve held rates steady at 3.5 to 3.75. No change. Textbook says this is a pause. Markets say different. Kevin Walsh walked into his first meeting as Fed chair and immediately changed the game. The statement cut to almost nothing, so we are not expecting any cuts anytime soon. Like maybe I'll talk about it later. Let's just finish this. Forward guidance that his own dot projection absent. He didn't like put his own dot, so and then he dropped this line: inflation is a choice. Uh, this wasn't a comment, there was a threat. So I'm sure most of y'all watched the conference, and it was really important to watch it. And we have a little chart. We have a little chart here, which I was reading on Twitter a couple days ago. Like the federal fund rate doesn't have like a boss, but the it was a I wouldn't even like call it the joke, but it was like a joke that it does have one, and it's called a US 2-year yield, because as we can see it does follow it quite precisely, and as you can see it's now going up every like year yield is going up, so we could expect a hike, and I will talk about it more just right here. So in March, zero FOMC members wanted a rate hike in 2026. In June, 9 out of 18. 3 wanted 50 basis points, 1 wanted 75. The median dot went from pricing a cut to pricing a 12.5 basis point hike. The market reacted instantly. Fed funds futures flipped from 0 hikes to a 51.7% chance probability of a September hike. 2-year yields jumped from 13 basis points to 4.18%. The dollar broke above 100 for the first time since March. And here's the kicker. This happened while oil crashed 30% from its peak. Brent below 80%, markets completely repriced the Fed's reaction function despite energy prices cratering. That's how powerful Walsh communication was. So, yeah, we can see right here the dot plot. In 2026, there are, like I said, 9 out of 18 expecting a hike. 3 wanted 50 basis. Yeah, right here. So, and then oil crashed. I'm not crashed, but like went lower, which might come back up since Iran just announced that they will close the Strait of Hormuz because Israel attacked Lebanon. I'm pretty sure it was that. We can, if it's on top of here, I will look at it, but no, it's not here. So yeah, you can search it up yourself, but it's something like that, I'm sure. The hidden message. Market isn't confused. The market heard exactly what Warsh was saying. Warsh deliberately refused to provide forward guidance. He didn't submit his own dot. He announced 5 task forces reviewing communications, the balance sheet, inflation framework, productivity, and data usage. He's signaling that the old rules don't apply. This is Greenspan 2.0, where uncertainty is the policy tool. By removing guidance, Walsh forces markets to price in more volatility, and by letting the market run hot on a high expectations without pushing back, is effectively tightening financial conditions without moving rates a single basis point. That's the hidden hike. So we can see, I found this chart somewhere, I'm not sure. It does say Bloomberg, but it's not. This is not how Bloomberg looks. But the markets, I have it right here. Uh, the markets have priced in one full 25 BPS hike and is starting to price in a 30% chance of a second hike for 2026, which is more important if even which is more important than if they actually hike, because what you want to do is trade before they actually hike, because if they already hike, that's already priced in, so you will be late. And then we have the winners and losers. The dollar wins. The dollar is up 1.5% since war spoke. That's the strongest week since April 2024. The dollar is now the single most supported G10 currency. The pound loses while Wars is talking hikes. The Bank of England just held rates 7.2 and MUFG, or however you read that, dropped their high call entirely. It's a bank. UK inflation is undershooting, the labour market is cooling, and Andy Burnham just won the Makerfield by election, opening the door to a Labour leadership challenge. Fiscal uncertainty, weak data, policy divergence, sterling is drowning. Cable is testing 1.32 support. The next key level is 1.3. The yen losses, Bank of Japan hiked to 1%, but USD JPY is knocking on 1.162. Japan's real rate is still the lowest. It's actually not. I have this wrong. Sorry about it. Because Chef has the lowest rate. Intervention threats don't matter when the Fed is still hawkish. I've talked about this in my Discord that they've only been able to intervene when the the US dollar was weak, or like they had weak data. So I don't think their intervention will work right now. The loonie losses, USD CAD is at 1.4140. 2-year spreads have widened 50 basis points. I'm not. I think it's more like 40. I have some info here wrong. Sorry about that. Since May, CAD shorts are at extreme levels. We have this, and I forgot to add Euro USD short, which is a no-brainer in my opinion, because Euro growth is really bad right now. Like no, it's bad. It's not good. So USD CAD up, longing that. Spreads onto your yields. Then we have USD JPY. This is risky if they intervene. You might get stopped out, but I feel like it will go more up. GBP USD short and dollar strong. The trades, so pretty much like just what I talked about here. Short GBP USD target 1.3. This is the most policy divergent G10 pair right now. Fed hiking bias versus Bank of England on hold. Political risk, weak data. Danske Bank's AI sentiment analysis shows the MPC has shifted into high uncertainty hold mode. The bar for a hike is now very high. Short AUD NZD target 1.195. RBA is done hiking. RBNZ is still leaning hawkish. China weakness is an additional headwind for AUD. The RBS Q2 CPI on Tuesday will be the next catalyst. Also, any further escalations that might turn into a risk-off environment will be worse for NZD than AUD. NZD is more sensitive to that than AUD. So this is not like the cleanest trade, but it is valid. Watch USD JPY 162 is the line. If Japan doesn't intervene on the US holiday, the path to 165 is open, but be careful if they do intervene. You're looking at a 3.3 to 5% move lower. So we have all of it right here. This is pretty much what I talked about right now. And then the warning, this is the last thing. Most retail traders think the Fed is done. They see a pause and assume hiking cycle is over, but that's precisely wrong. The pause is the most hawkish thing the Fed could have done. They've created a maximum uncertainty. They've let the market price hikes without commenting to them. They've tightened financial conditions without moving rates. And if inflation stays sticky, watch the PCE print next Friday. They'll have every excuse to follow through. So pretty much a lot of stuff is saying they will hike, but it's not important if they hike. It's important if the markets are like pricing that in, because that's what you want to trade. Because if they already hike, or even like a month before hiking, it's probably already priced in. So you want to be early. And that's it from today's video, and I'll see you next time. Bye.